Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment. Now, here's your host, hedge fund manager Eric Townsend.
Welcome back to another episode of Financial Repression Authority's Weekly Roundtable. I'm your host, Eric Townsend. I manage a hedge fund. I also host the Macro Voices podcast at macrovoices.com. On our panel this week, we have Yra Harris, an independent trader who previously managed a hedge fund very successfully. Ira is a global macro consultant. He's traded Forex, currencies, commodities, and equities for 39 years. He was also a director of the CME Group from 1997 to 2003 and is the only floor trader to serve on the CFTC's Financial Product Advisory Committee under Wendy Graham, Sheila Bair, and Brooksley Bourne from 1993 to 1998. Also with us this week is Richard Benuli, who is a management consultant specializing in the areas of market risk, credit risk, and operational risk. Gentlemen, thanks so much for joining me this week on the Roundtable. I want to start with a topic that has been on my mind quite a bit, and Ira, I think you've done quite a bit of writing about this, which is the European banking system. My friend Raoul Paul has said that he thinks that we're really seeing some very serious warnings coming from Deutsche Bank in particular. And of course, this is a story that's been ongoing for well over a year now. Other people, I just interviewed another expert last week who said, hey, Deutsche Bank is a buy here. It's a value play. That came from Mark Yusko. So two very different views. How do you guys see this situation with the European banking system? Is Deutsche Bank potentially signaling Europe's Lehman moment, or is this no big deal?
We don't know. And when they say it's a buying opportunity, I'm not going to challenge that. But I'll tell you what, if you thought that highly of it, you may as well go buy those COCOs, the contingent convertibles, because they're paying a nice yield. And then you're going to wind up with equity anyway if they force that, if the Tier 1 capital drops to low enough where they're going to convert the debt to equity. But we don't know. Will they let Deutsche Bank go? Not a chance. Deutsche Bank's probably as safe as J.P. Morgan as far as a moral hazard, because it has such great systemic risk to the total global situation. So I understand why people say it. I would want to buy it, but I'll wait a little bit. I didn't have to jump in on Citibank at the bottom too. I want to see how more of this plays out and to see what the noise comes out of from the BIS. But I certainly understand people saying that because it's a bet on the fact that the EU and especially Germany, who really is the locomotive of Europe, will not allow Deutsche to fail.
And Richard, how do you see this?
Yeah, there's extensive systemic risk because of the fact that Deutsche Bank is one of the world's largest notional derivatives books in terms of notional value of about $46 trillion at the end of last year. And although you can net a lot of this out, it still represents a lot of risk in terms of a potential for derivatives meltdown between counterparties. And the notion as well is taken to the ECB, in terms of a European banking risk, because while the ECB balance sheet has grown already from 2 trillion to 3.4 trillion euros in just 18 months, there's really only about 7.5 trillion euros outstanding Eurozone sovereign debt. And so they're basically almost halfway there. Some of the debt is ineligible for purchase under the program, but it does represent a challenge going forth in a very quick period of time in terms of the overall systemic risk to the European banking system.
I want to agree.
If I could interject, Richard brings up a good point, because everybody will, you in the mass media, when you turn on different channels, they talk about, well, it's notional. And I think Richard's point is well taken, because it's not only notional. Okay, yes, we know that there's a net value to it, but again, its risk profile is based on Deutsche's own, value at risk models, the VAR models that they use. So we really don't know what their exposure is. And we've certainly learned to dispose of those VAR models because they really don't represent what the true risk either. And it's more, and I guarantee you, it's a higher. It ought to be a higher risk weighting than they reveal.
So I want to start by agreeing strongly with both of you guys. I think that if you were to look up the phrase "too big to fail" in the dictionary, you just might find a Deutsche logo there, because if Richard said the size of the derivative book is so big, it would cause just a financial domino effect from hell if Deutsche were ever allowed to fail. So I agree completely. They can't let it go. But hang on a second. Politically, it would be extremely difficult for the ECB to bail it out. And in Germany, it would be incredibly difficult to bail it in and have Germans lose deposits. So if you can't bail it out, you can't bail it in, and you can't let it go, how does this resolve itself? What happens?
Yeah, well, when you say, listen, the bail-in will be politically, you can forget it. Merkel's is in severe trouble now. And everybody wants to talk about, the same way they talk about Brexit. Well, it's just people, what are those, what was Hillary Clinton's phrase about the people who are, xenophobic, what does she call it? Whatever the phrase, that they made it into an anti-immigrant. Well, and the rise of the alternative for Germany, the AfD party, is far more than an anti-immigration. That's for the headlines. I believe, and certainly the topic that Gordon Long and I've talked about for a long time, if you want to see financial repression, watch what the ECB is doing to the savers in Germany. Germany is bearing it. The German savers are bearing the bailout of the entire European project because, German growth is far better than it is in the rest. Their unemployment rates are low. Interest rates in Germany should be 2.5%, 3% by any standards. And I'm talking about on the short end. And yet, of course, we know they're negative because of the bailout of the entire European Union project. And if there was a bail-in, as you rightly note, Eric, that would cause even more political angst. And I hate this phrase because I'm not one of those economists. On the other hand, there is no other hand, but the politics of this, even from a European-wide situation, is thus. If, Mario Draghi would like nothing more, as Richard pointed out, that balance sheet has grown. Well, if he grew it another trillion, he'd be the happiest guy in the world, because then you're making the project, you won't be able to unwind it. I call that the Bronx Tales syndrome from the movie The Bronx Tales, where they close the doors when the bikers come into the Italian neighborhood bar and they say, now you can't leave. Well, if that balance sheet grows big enough, nobody can escape the EU ever. And the German taxpayers will be on the hook for this entire thing regardless. So if it meant that Mario Draghi was busy buying Deutsche Bank debt, so be it. So I think that's probably the way that they want to go first and foremost.
And Richard, what's your view? If they can't let it fail, what do they do to save it?
It's going to be very challenging to the German government. They're boxed in essentially. It could go in the way of a bailout, and by estimates that Ms. Shedlock has come forth, that would be approximately 100 billion from the estimates he's seeing, to potentially a bail-in, as part of financial repression, where there's a wealth confiscation of assets that takes place at the capital structure layers, from anywhere from the bank depositors all the way to senior secured bondholders and so on, in terms of the capital structure. So it could happen either way, or a combination of both. Or you have the European Central Bank step in and monetize a lot of the bailout as well, in terms of assistance for quantitative easing programs.
Yeah. Richard, if you want me to let you sit uneasy, I asked this question. I can tell you the exact date. It was June 29th in Chicago. Jerome Powell, the Fed governor, was speaking in Chicago.
Yeah.
And I asked him a question in a very open forum. I called on me. And I asked him, who guarantees the ECB? And is that a problem for him? And he gave me the answer I knew he would give me, but scared the Jesus out of me, which was, oh, they have a printing press.
Yeah.
I hated that answer. I was gnawing on my fingers. I hated that answer, but I knew that's what he was going to say. And that's the answer. We have a printing press. It will never rest easy with me, that answer.
Speaking of central bank policy activity, we're taping today's roundtable on Wednesday afternoon. So we've got an ECB meeting coming up. We had a speech from Yellen last week. What do you guys think about, is the ECB able to do anything meaningfully in terms of policy here that's going to affect a resolution to this, or are they really just sitting by the switch waiting to see what's going to happen?
You know what? I think that Mario Draghi would like to increase QE tomorrow. Everybody talks about tapering. There's no chance of that. There's no chance of that. He's under a lot of pressure. I mean, over the last week and a half, we've seen a major article on Otmar Issing, and in one publication, European publication, and then another piece from one of my favorite people. I like Issing, but I also have great respect for Axel Weber. Really talking about the trials and tribulations of what the ECB has done. So there's a lot of pressure building on the ECB. And Draghi, I think, is a man in a hurry. He would like to, again, I think, build that balance sheet up so massively, only, again, to keep trapping the Germans, as Richard's pointed out. The Germans are trapped here. They're walking into it, and it goes back to how Merkel was totally manipulated by Sarkozy. I always laughed when they talked about Merkozy. Well, now that we have Merkel and Hollande, should we just call that Merde? Because that's exactly what this is for the Germans. They're in deep. I'll watch my language. They're in deep crap up to, and it's now no longer up to their knees. It's way beyond that. And you know what? The Germans are starting to wake up to that. And so I think Draghi is in a hurry to build that balance sheet up bigger and bigger and bigger.
And Richard, what's your take? Do the central bankers have any more tricks up their sleeve that are going to work, or are they running out of tricks at this point?
Yeah, I think they're running out of tricks. They're running out of ammo. I'd like to read a quote from the ECB's first chief economist, Professor Otmar Issing, that embodies the whole challenge. He says the European Union is a house of cards, and his quote is, "One day the house of cards will collapse. Realistically, it will be a case of muddling through, struggling from one crisis to the next. It is difficult to forecast how long this will continue for, but it cannot go on endlessly. An exit from the QE policy is more and more difficult, as the consequences potentially could be disastrous. The decline in the quality of eligible collateral is a grave problem. The ECB is now buying corporate bonds that are close to junk, and the haircuts can barely deal with a one-notch credit downgrade. The reputational risk of such actions by a central bank would have been unthinkable in the past." So he embodies it in several of those ideas.
I have the same quote sitting right in front of me. I have the article from the Telegraph the other day. I'm laughing because it sums it up pretty well. It's really.
Let's bring the conversation back to the U.S. equity market. If we look at the uptrend that's been in play pretty much all year, I think the lows that you might draw a line through on the chart would be February 11th and then June 27th are the two low points. If you draw that trend line, we've now broken out of that. We've broken sideways out of that uptrend. And from all the technicians that I'm reading, they're basically saying, okay, we're kind of at a point of we better watch very carefully about 21, 25 or so, because thus far we're just looking at a sideways consolidation as we've broken out of the uptrend. But any daily close below 21, 25 would start to suggest maybe a break to the downside is coming. How do you guys see the equity market here? Why don't we start with you, Ira?
Well, to me, and I'm looking at the chart now that you put up, and I see exactly, and I know this big area. the equity markets is fairly valued, I'd say, based on any metric that you want to use. I know it's hard to value them because, again, and it's not new. I think people who look at the world in similar ways that I do, for 5 or 6 years, there's been no alternative to owning stocks. Bond rates, now they're negative. So you've been caught in this situation. I think the equity markets are vulnerable to a sell-off here, and I'm not talking about a crash or anything, but I've been writing about this, and I think this for the biggest reason is, Wall Street would like Hillary because Hillary is a steady hand that it knows. But that being said, she will certainly raise capital gains tax in order to buy off the left side of the party who has supported her and she's had to go running to. And if she doesn't raise the tax, she will certainly raise the holding period in which you can attain capital gains. So I think that people who have been in this market and who have long-term capital gains will sell that which they can before the end of the year. And I know I'm thinking the same way. I'll deal with what I know rather than the unknown. So I think that makes this market vulnerable. I also think, as Danielle Booth wrote today, and it's not a new issue, it's the corporations have piled on so much debt in only making sure that they can keep paying dividends and doing share buybacks. And I think that weighs on this market dramatically. Here we are talking on the Financial Repression Authority, and all things that get in trouble financially always come about because of debt. And the amount of debt piled on the balance sheets around the world is just enormous.
And Richard, how do you look at this equity market?
I think to support Ira's view that the markets are very vulnerable, also from the perspective of not only of overvaluation measures and all of the debt that's overhanging and providing a challenge for servicing that debt, but also from the perspective of what everybody is talking about in terms of the potential for helicopter money. For doing projects like infrastructure projects, energy, and that would provide a stimulus, to the financial markets as well as to the economy. But the prompt for that for central banks will likely have to be some type of deflationary whiff in the asset markets, going down significantly to some level enough that it prompts central bankers to push fiscal authorities to have the political will to bring the political will together in order to do a fiscal stimulus. So I see it sort of playing like that. I'm not sure quite on the time frame, but if you look at that, coupled with increasing central bank buying of stocks, witness Japan, Switzerland, other central banks, that will likely support stock markets in an artificial sense going forth.
I think, Richard, that's a very good point. And I think to support that point, in a Clinton cabinet, or if Hillary Clinton gets elected and she buys off Elizabeth Warren by whichever way she chooses, we will line up with Larry Summers as the next Fed chairman. And that will be a real tell as to how far they will take the fiscal stimulus, because then it'll be interesting, because under a Summers Fed, you would have the Fed monetizing the fiscal stimulus directly. I believe that. And I think that'll be a very important tell in the game.
I think that's an excellent point. Since both of you have mentioned the presidential race, why don't we touch on that? Because something I've noticed that just a week ago, Donald Trump was being absolutely ridiculed as a nutcase for having made these comments about the election being rigged. Everybody thought, well, that's just utterly baseless nonsense. Now this week we have these investigative journalism videos out, very clearly documenting just widespread and rampant voter fraud and voter manipulation. Does this change the game? Does Donald Trump suddenly have a chance now? And what will it mean for markets if the perception of Hillary being a shoo-in is lost in the coming weeks? Ira, you want to kick it off?
Well, I'm from Chicago, so I know all about election fraud. I grew up in the city. I know how the Democratic machine worked. I was right at the perfect age. I spent many years on the streets demonstrating against the daily machine in many ways. So, the way he points, he wants a broad figure it, and based on the Electoral College, I'm not sure that his view really resonates. Yeah, I know people want to believe what they want to believe. I have my problems with Donald. Is the Republicans? This was their election to win, and they've done. It's like my beloved Cubs the last two nights. They're stuck on zero. So I don't know about that. It's very hard to make that decision. But I think if it was a Trump election, the first effect, of course, would be that the financial markets would be very nervous because of all the things that not that he could put into place what he's talked about, but the markets don't like those unknowns, and he's such a wild card.
Richard?
Yeah, I agree with Ira, and it's just going to present a lot of unknowns and a lot of uncertainty. Representing high volatility, translating into high volatility in the markets. Like if you look at Trump, maybe he may be anti-trade, so that could affect a lot of international type of companies that do a lot of trade, negatively, and then there could be some geopolitical events if Clinton gets elected in terms of war type of scenarios, which would negatively affect the markets as well.
The one place where I think he is right, though, and this is going to play out, and Richard brings up that good point about geopolitical events, is that I believe that what he doesn't know why he's right about this, not from at least the way he presents it. NATO is over. It's over. And anybody who doesn't think so really does not pay attention, because the question I would ask when I say that to people, I go back to, I don't know how old you are, Richard. When I was in school, of course, the issue was the one China debate. Would the United States, which resulted if China, after Nixon went to China, would the deal be made to sell out Taiwan because China's always pushed for one, and how far would the United States go to defend Taiwan? Well, the issue with NATO now is if Putin attacked Turkey with, Hillary Clinton, and she's very vulnerable on this because she, on that one debate that I happened to watch, and she talked about, what is that, the 0.5 of the NATO agreement, which is collective action. Would the United States risk nuclear war to defend Turkey? And if your answer is no, NATO is over. Because Putin this is where the geopolitical risk lies. Putin keeps looking for pressure points to find out how to get rid of NATO, because he despises NATO because he thinks that they lied to him, that they lied to the Russians on what would take place, of course, after Gorbachev and Reagan, and after all the agreements between Mitterrand and everybody else, and that those have been reneged on, and that NATO would never reach beyond Germany. And we know that is not the case. So I believe that NATO is over, and that what will come out of there, I can't tell you, but I believe that NATO has seen its last days.
Both of you mentioned the fact that markets hate uncertainties, and several people have now laid out the possibility that if Donald Trump were to pull off a surprise upset victory on election night, that there would likely be calls to say, hey, this was Russian tampering, and the election results should be either voided or at least put on hold until an investigation could determine whether or not foreign interests undermined the election. If that were to occur and there were, let's say, a repeat of the 2000 election where there's at least a week delay as everybody's trying to figure out, okay, did Bush win or did Gore win? Are we going to recount the votes in Florida? If we had a repeat of that, it seems to me markets are already feeling pretty vulnerable. What would that mean to markets, and do you guys see that as a realistic scenario? Ira?
That would unnerve markets. I don't see it as a scenario. This has been a bumbling, already you have the administration, the present administration pushing back and say that they could just as easily, create a cyber attack upon Russian servers. And so I really don't see this. And the way that Trump has been going, to me, the more interesting question is if the polls, for whatever the polls are worth, show Hillary with a double-digit lead, like in the next 2 weeks, let's say by October 31st, my question becomes, will the Fed, in search of its own credibility, raise rates at the November meeting if her polling numbers are that big? That, to me, is a more interesting question. The others are just, beyond my ken to answer.
Richard?
The aspect that I would like to emphasize too is on, other factors as well. While we have this election and, we look to what the consequences could be of one of the parties winning, it will provide likely a great deal of social unrest in the United States, which could translate into a lot of economic uncertainty, both in the economy and then financial uncertainty into the financial markets. But I think still there's a lot happening outside of the U.S., outside of North America, that could actually help to propel U.S. markets higher with a strengthening dollar. If we look at just what's happening in Europe with the European banking crisis, money leaving and coming to the United States, in search of safer areas to invest, that could have a positive effect on the dollar, a positive effect on U.S. equity markets, sort of as a greater force.
Let's stay on that topic of the U.S. dollar. Last week, we saw a breakout for the first time since February above 97.50, which had been a fairly key resistance level on the dollar index. And as tends to happen in technical analysis, we saw a rally up to, I think it was 98.12, and then a retrace back down, just kissing that 97.51, I believe, was the low print, and now we're back up to 97.95. So it's starting to look like the making of an upside breakout in the dollar index from a consolidation period that's lasted for about a year now. Is this the beginning of the resumption of the dollar rally, or are we just looking at some noise here? What's your take, Ira?
Well, it's yes, that's a great question, because I try to wrap my head around this for the last 24 hours. When we talk, and Richard has brought it up, I brought it up, Eric, you brought it up. When you look at the problems, as Richard rightly just noted, around the world, it's hard to believe that the euro is still above par. And yet, there it is. So, and the yen is, still 20% higher on the year. Yes, for all types of reasons, but I'm amazed that the dollar hasn't rallied already. So it makes me concerned that, yes, I see the rally going on in the dollar index, and I see the 200-day moving averages and the Swiss, the euro, certainly the British pound, but other currencies give way. And I go, the dollar looks like it should rally, but when I look around the world, and this is, for all of us who trade and invest for a living, it ought to be a lot higher. The fact that it's not really resonates with me, and I'm wondering what am I missing here? So I've kind of stepped back and I'm watching very closely, and tomorrow's ECB meeting may give me, because if they do nothing, I want to see what happens to the dollar. If they announce no change at all and Draghi is somewhat, just steady as she goes at his press conference, I want to see the way the dollar reacts. Because if there's the fact that the euro hasn't broken, I would look for a dollar rally. I would look for the dollar to sell off. I'm sorry, tomorrow. I would look for a euro rally if the ECB does nothing and Draghi sounds very confident going forward. So tomorrow gains some interest for me.
And Richard?
Hard to say overall in a sort of medium-term, long-term sense. The way I see usually the central bankers are working in a concerted way to manage the stability of currencies relative to each other. Although the purchasing power of the currencies may be going down over time, the exchange rates may be held fairly stable. With the U.S. dollar having a tendency to get stronger for a number of reasons, as we've discussed. But overall, it's what we're looking at is more of the decline in the purchasing power of money, regardless of currency.
Amen. Amen. And let me build on what Richard brings. Here's a really interesting point. And Eric, you pull out the charts. If you pull out the charts from the Chinese yuan, and we go back to that low that you definitively stated in the S&Ps from February 11th. Well, February 1st was a Monday, and it was the weekend after Soros and Druckenmiller and Tepper. They all came out over that weekend and said, well, they look for the yuan to depreciate 30%. Do you remember that?
I sure do.
Okay, that was over that. So February 1st was that Monday following that weekend. Well, I happened to be on with Rick Santelli that morning, just by happenstance, because it's always scheduled a couple of weeks ahead of time, and we didn't know what we were going to talk about, but I spoke to that issue because it was a hot issue. And I said, well, if you believe that the yuan was going to depreciate, I said, I would just buy gold and buy bonds, because that means that the Chinese would be exporting massive deflation around the world. Because we know if you're going to do that, then they're doing it to export, and their excess capacity would create a major bout of deflation. And I said, then the banks are out of ammo. I just buy gold and buy bonds. End of story. In which it was that was a good call. So I'm blowing my own horn here, if you'll allow me for the moment. But I bring that up only because the high of that week, when everybody said, oh, the yuan's going, that high was about 6.63, I think, on dollar yuan. Well, we're 2% above that now in the dollar. And yet the S&Ps are hanging on their highs, and everything else is kind of meandering around here. So I just bring that up because it's something to put on everybody's radar screen, because we're above the highs that the dollar made back then, but yet all the other asset classes have not responded to it. And last night, of course, was a classic night, because lo and behold, the Chinese GDP hit the exact number that was predicted. I mean, this is like Jack Welch, with his GE, manipulating the quarterly earnings of the GE when he was the chairman. So I kind of laugh at it, but I think it's something to pay attention to. That, as Richard rightly said, this is about global assets, and they're all somewhat in trouble here, and it's something to pay attention to.
Well, let's try to pull this all back together then to a topic that I know is near and dear to our listeners' hearts, which is asset allocation models and portfolio construction. Because if I summarize this interview, I think we're all in agreement that central bank policy has gone pretty much haywire. Nobody's sure what to expect next. We're all waiting at the edge of our seats to see what will happen. We agree they cannot possibly allow Deutsche Bank to fail. They politically cannot afford to bail it in or bail it out, which seems to be all of the options. So what are they going to do? Presidential election, crazy stuff. Nobody knows what all this means. What in the world do you do in this kind of environment in terms of portfolio construction and asset allocation? Ira, you want to kick it off?
As my friend James Aiken would say, trade to make money and invest accordingly, which is, I wouldn't be building anything long-term here, because I think you'll have much better opportunities. So I'm really treating everything that I do in a very short-term perspective. If I can make money buying equities, like last week, I started after I bought American Barrack, and I'm not touting it. After I read Yellen's speech on Friday, I found it such an abomination because she basically said she knows that the Fed models, and they know that the Fed models are flawed. And my response was, it's nice that you come and ask these questions after you've built up a $4 trillion balance sheet. So, that's the way that I'm looking at the world. I go to sleep at night very uneasy because, there's just too many things out there that, as I said, as I wrote on January 4th on my blog, it only takes a single spark to start a prairie fire. And there are bundles of tinder all over the globe that can be ignited into a major prairie fire at any time. So I advise treat everything as a short-term trade. If you can turn it into a profit, go ahead and then go on to your next one.
Richard?
Yes, I agree with Ira on that approach, and it's very difficult to say in a medium or long-term sense because of the strong barbell and tug of war that's happening now between inflation and deflation type forces. On the one hand, you've got strong deflationary forces that are natural, that are happening in the economy, in the financial system, very, very deflationary in nature, being counterbalanced by the very inflationary forces provided by central banks, monetary authorities to counterbalance that deflation. So it could go either way in a medium term, and then it would be difficult to quickly change your portfolio, but perhaps a diversified portfolio in the medium long term with the short term trading strategy that Ira mentions. Another aspect too of this question is to look at using some of the principles from the Austrian School of Economics applied to investing, namely looking at stores of value, which makes sense in the current environment. How do you come up with investment strategies, asset allocation strategies in a risk mitigated way, given the challenges today of 0% interest rates, negative interest rates. Or another answer is looking at companies with little or no debt because of the large amount of debt. Little or no debt, high discounted free cash flow with little or no leverage. So companies that are boring, basic businesses are tending now to put out some good cash flow.
Well, we live in interesting times, to say the very least. Gentlemen, I think we could continue this conversation for another hour, but unfortunately we have run out of time. I know that a lot of our listeners would like to follow your work and learn more about both of you. So, Ira Harris, where can our listeners find your blog, and where else can they follow your work?
Okay. The blog, if you go to YRA Harris, HARRIS.com, you can then, Notes from Underground, which is the name of my blog, and great deference to Dostoevsky, who also railed against the great rationalists of his time, or model builders, as I'll call them. And you can register for it. It's free. I try to write 2, 3, 4 times a week, depending what's out there. And also, if I could plug something here, I make no money on it, but I think it's so important for all your readership. There's a good friend of mine, Bernard Connolly, who wrote, I think, the most important book of the last 20 years called The Rotten Heart of Europe, in which he brings forward out of an Austrian perspective, so Richard would really appreciate that. The book was out of print. I printed 10,000 copies for my friend Bill Shepard and I, and I hand mail them. Anyway, Amazon just took me off the site because they said, even though I've never had one complaint, I've probably mailed 2,000 books and never had one complaint, but they took me off because of the tracking. So if you go to rottenheartofeurope@gmail.com and give me your order, I will send you a book, and it'll be $10 all in, shipping and everything. and I'll take you on your word and you can take me on my word, and I will ship the books out to whatever address, but make sure you leave your mailing instructions. This is the most important book. I hope to get it back on Amazon. I'm dealing with them right now. I'm not happy. But if you go to Rotten Heart of Europe, the Rotten Heart of Europe at gmail.com, you can get to me directly, and I will ship the book to you.
At a cost of $10, hard to beat. And Richard,
you cannot beat this. This book is so important. Just reading the foreword that Bernard rewrote in 2012 is worth the price of the book. End of story. And don't try to read it on the Kindle. Not possible.
And Richard Benuli, how can our listeners follow your work?
Yeah, I think probably the best way for the listeners here is to go to the website www.financialrepressionauthority, all one word, .com, FRA's website. There's also a social media YouTube channel where there's a number of interviews, many of which Gordon T. Long has interviewed some of the best economists, fund managers, and industry leaders worldwide. You can listen to those. A lot of them are videos as well that have embedded presentation slides. And I'd just like to mention my word of the to highlight, as Ira has, would be a quote from John Malden this past week, where he mentions about the U.S. elections and monetary policy. He says, "I think the shape of monetary policy in the U.S. is more important than who we elect president, unless the new president actually changes the people who shape our monetary policy."
Excellent. And finally, I also host the Macro Voices podcast, which is published every Thursday evening at macrovoices.com. That wraps it up for this week. Listeners, please be sure to tune in again next week for Financial Repression Authority. I'm Eric Townsend.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.